Let's be honest. Everyone wants to make money in the stock market, but the truth is the majority won't. In fact, studies consistently show that nearly 97% of investors are about to lose money. Everything makes a good investment, not because the market is, not because the opportunities aren't there, but because of how people approach investing. And if you're watching this, chances are you don't want to be part of that 97% investment. Think about it whenever there's hype around a stock, a new crypto coin, or some hot real estate play, the majority rush in when it feels safe. But the market doesn't reward safety, it rewards patience, strategy, investment, and discipline. The painful reality is that most people are making the same mistakes over and over again. They're buying high, selling low, ignoring risk management, and letting emotions run their portfolios. Now, let me give you a simple example. Imagine someone who heard about a stock doubling in value. They jump in thinking they're about to ride the next wave. But guess what? By the time the masses hear about it, everything makes a good investment, have early investors taken profits, and the newcomers end up holding the bag. This is why the majority lose money, not because the opportunity wasn't there, but because they didn't understand timing, cycles, and strategy. Here's the reality: the stock market is designed to transfer wealth from the impatient to the patient. And that's exactly why most investors fall into the losing side. They treat investing like a lottery ticket instead of a disciplined wealth building tool. The second major reason people are losing money is a lack of long-term strategy. Instead of building a plan that focuses on consistent growth, they're chasing shiny objects. They want to double their money overnight. They get caught up in hype-driven assets, hoping for a quick score. And when it doesn't go their way, they panic sell at a loss. If you've ever felt the urge to sell just because the market dipped, congratulations, you've experienced exactly what puts most people in that 97%. But let me tell you something critical. It doesn't have to be that way. Losing money isn't inevitable if you understand the rules of the game. And history has shown us repeatedly that markets move in cycles, periods of extreme optimism followed by painful corrections. Yet, time and time again, investors ignore the lessons of the past. Instead of preparing for downturns, they act as though the good times will last forever. And here's the kicker: risk management is almost always overlooked. Too many investors put all their eggs in one basket, borrow money to invest, or fail to keep any cash reserves. When the market shifts, they don't just take a small hit, they wipe out their entire portfolio. That's the difference between professional investors and the average person. Professionals expect downturns while amateurs are shocked by them. So when I say 97% of investors are about to lose money, investment, it's not meant to scare you. It's meant to wake you up, because the truth is you don't have to be part of that statistic. If you're willing to step away from emotional decision making, if you can build a long-term plan, respect market cycles, and manage your risk, you'll be among the 3% who don't just survive, but thrive. The choice is yours. Follow the herd and become part of the 97%. Or take a disciplined, strategic approach and put yourself on the winning side. When it comes to investing, the single biggest reason why most people lose money has nothing to do with bad stocks, bad timing, investment, or even a bad economy. It comes down to emotions. Human psychology is the silent killer of wealth. People let fear, greed, and hype dictate their financial choices, and that almost always leads them to make the wrong move at the wrong time. This is why you often hear the phrase, or buy high, sell low, because it's exactly what emotional investors do. Everything makes a good investment, even though logically we all know it should be the opposite. Think about how this plays out in real life. A new investment trend starts gaining attention. Maybe it's a stock that's been going up for months. Maybe it's a cryptocurrency making headlines, or maybe it's real estate that's doubled in a short period of time. At first, people watch from the sidelines. They're cautious. They think it's too risky. But as the price continues to climb, the fear of missing out kicks in. They see friends making money. They read articles about overnight millionaires, and suddenly logic takes a back seat. They jump in, investment, not because it's a good value, not because it aligns with their strategy, but simply because they don't want to feel left behind. That emotional decision sets them up for failure. By the time they enter, they're often buying at inflated prices near the top of the cycle. Then what happens? The market corrects, as it always does, and panic sets in. The same emotions that push them to buy now force them to sell. They can't handle seeing their portfolio in the red, so they sell at a loss just to escape the discomfort. That cycle, buying high out of greed and selling low out of fear, is the exact reason 97% of investors are losing money. The ironic thing is, rationally, people know this is the wrong approach. Everyone has heard the phrase buy low, sell high. But when emotions are involved, common sense gets thrown out the window. The brain becomes wired to react in the moment, not to think long term. And this isn't just about the average retail investor. Even experienced investors fall into the trap when they let emotion override discipline. Another form of emotional investing comes from overconfidence. Investment. After a few good trades, some investors start to feel invincible. They believe they've cracked the code, that they have some special insight the rest of the market doesn't. Investment. That confidence leads them to take bigger risks, leverage their money, or throw everything into one investment. And while it might work temporarily, eventually the market humbles everyone. Investment. One bad move wipes out months or years of gains, all because emotions created an illusion of certainty. On the flip side, fear is equally destructive. Some people never invest at all because they're paralyzed by the possibility of losing money. They sit on the sidelines year after year, waiting for the perfect time to invest, which never comes. The result? They miss out on years of compounding growth, and inflation quietly eats away at their savings. Fear costs them more than any market downturn ever could. The truth is, successful investing requires a mindset shift. It means understanding that markets will always move in cycles, that downturns are inevitable, and that emotions will always tempt you to make the wrong choice. The discipline lies in resisting that temptation. Investment. It's about having a plan and sticking to it, even when it feels uncomfortable. Rational investing isn't exciting. It doesn't give you the thrill of chasing hype or the adrenaline rush of gambling. But over the long run, it works. If you want to avoid being in that 97%, you need to start recognizing when emotions are influencing your decisions. Ask yourself, am I buying this investment because it's a good long-term value or because I'm afraid of missing out? Am I selling because it makes sense strategically or because I can't handle seeing short-term losses? Those questions are the difference between losing money and building wealth. At the end of the day, markets don't punish people for bad luck. They punish people for bad behavior. Investment. And the worst behavior of all is letting emotions run your portfolio. The investors who succeed aren't the smartest, the fastest, or the luckiest. They're the ones who can stay rational when everyone else is emotional. That's what separates the 3% who win from the 97% who lose. One of the biggest mistakes that almost guarantees investors will lose money is failing to have a long-term strategy. It makes a good investment. Most people don't go into investing with a clear plan. They go in with excitement, with hope, or with the idea that they'll figure it out as they go along. And while that might work for a short period, over time, investment almost always ends in disappointment. The truth is, markets reward discipline and patience, not impulsiveness and guessing. Without a roadmap, investors drift from one opportunity to another, chasing whatever looks shiny in the moment. And that lack of direction slowly erodes their wealth. Consider how the average investor behaves. Investment. They'll see a stock climbing and buy into it without asking whether it fits their goals. Then, when the stock dips, they panic and sell. After that, that's a good investment. They might move their money into something entirely different. Maybe crypto, maybe real estate, maybe a new can't fail opportunity they heard about from a friend. In their mind, everything makes a good investment. They're investing, but what they're really doing is gambling. They're reacting to what's happening in the moment, not following a carefully thought out strategy that's meant to stand the test of time. A proper long-term strategy isn't glamorous, but it's what works. It's about setting clear goals, whether that's retiring comfortably, building passive income, or simply protecting your wealth against inflation, and then building a plan that aligns with those goals. For example, if someone's goal is to retire in 30 years, investment. The strategy should involve consistent contributions to diversified investments that grow steadily over decades. That's not exciting. It's not something you'll brag about at a party, but it's exactly what separates long-term winners from those who end up in the 97% who lose. The lack of a long-term strategy is also why so many people fall victim to market timing. They try to outsmart the market by buying and selling based on short-term movements. And while it sounds appealing to buy right before prices go up and sell right before they fall, in practice, almost no one gets it right consistently. Even professionals struggle with this. Yet individual investors keep trying, and every failed attempt costs them money. A long-term strategy eliminates the need to constantly guess because it focuses on the big picture, not the day-to-day noise. Another issue with not having a strategy is that people fail to account for risk properly. They don't think about diversification, asset allocation, or building a safety cushion for downturns. Instead, they go all in on one type of investment, and when that investment turns against them, they're wiped out. A solid strategy doesn't just plan for growth. It plans for protection. It anticipates downturns and creates a structure that allows you to survive them. Without that, one bad year can destroy a decade of progress. Investment. The irony is that building a long-term strategy is not complicated. It starts with simple, consistent actions, like automating investments, sticking to a diversified portfolio, and ignoring short-term noise. But because it feels boring compared to chasing the next hot stock or trend, most people don't stick with it. They get distracted, they lose patience, and they abandon their plan at the first sign of trouble. Growth in investment. That's exactly why they end up losing money. Think of it this way. If you were building a house, you wouldn't start throwing bricks randomly and hope it turns into something livable. You'd follow a blueprint. Investment. Investing works the same way. Without a blueprint, you might put together a wall here and a roof there, but eventually the whole structure collapses. Thus, a long-term strategy is the blueprint that ensures your financial house stands strong, no matter what the market throws at it. At the end of the day, wealth isn't built in a year or two. It's built over decades. But because most people can't think that far ahead, they sabotage themselves by constantly chasing short-term results. That lack of patience, that inability to stick to a plan, investment, is why the majority of investors end up on the losing side. If you want to be different, you don't need to be smarter or luckier. You just need to be consistent, disciplined, and committed to your long-term vision. That's what keeps you out of the 97% and puts you into the winning 3%. Another reason why 97% of investors are about to lose money is because they underestimate market cycles. They forget investment or simply don't want to believe that markets rise and fall in predictable patterns over time. This isn't something new. History has shown us repeatedly that every period of growth is followed by a correction, and every correction eventually leads to another period of growth. Yet, investors continue to act as if the current moment is somehow different, as if the cycle won't repeat itself. That kind of thinking is dangerous. And it's one of the biggest reasons people lose money. The reality is that markets move in waves of optimism and pessimism. When times are good, people convince themselves that the good times will never end. They see prices going up and assume it's the new normal. They load up on investments without thinking about risk because it feels like nothing can go wrong. But as soon as the cycle turns, panic sets in. Makes a good investment. The same people who were convinced things could only go up are suddenly convinced the world is ending. They sell everything at the bottom, lock in their losses, investment, and swear never to invest again until the next cycle begins and the whole process repeats itself. This behavior isn't just theory. You can see it in every major market event. Look back at the dot-com bubble in the early 2000s. People thought the internet was going to make every company successful, so they threw money at businesses with no profits, no stability, and sometimes not even a product. Prices soared until reality hit and the bubble burst. The same thing happened with the housing market in 2008. People believed real estate could only go up, that prices would never fall, and banks were lending money like it was candy. When the cycle turned, the crash wiped out years of gains and left millions of people underwater. The problem is that most investors don't study these cycles, or if they do, they believe this time is different. But history shows us it's never different. The names and circumstances may change, but the pattern remains the same: boom, peak, crash, recovery. Understanding this pattern is crucial because it allows you to prepare instead of being blindsided. If you ignore it, you're almost guaranteed to get caught in the downturns that wipe out the majority of investors. Another way investors underestimate market cycles is by assuming short-term trends will last forever. For example, when interest rates are low, people believe money will always be cheap. When tech stocks dominate, they believe technology will always lead the market. When crypto is hot, they believe digital assets are unstoppable. But cycles teach us that leadership changes, momentum fades, and trends shift. Those who fail to adapt end up losing big when the cycle inevitably turns. The danger is amplified by the fact that cycles are emotional. Investment. They don't just reflect numbers and valuations, they reflect human psychology. Optimism breeds more optimism, and fear breeds more fear. That's why bubbles inflate far beyond what anyone expected, and crashes fall deeper than logic would suggest. Investors who don't recognize this emotional element are always caught off guard. They assume markets are purely rational, but the truth is they're driven by human behavior. And because human behavior doesn't change, cycles repeat over and over again. But the smart investment investor doesn't try to fight the cycle, and they don't try to time it perfectly either. Instead, they build a strategy that respects the existence of cycles. That means being cautious during times of extreme optimism, keeping cash reserves, and preparing for downturns. It also means not panicking during crashes, but instead recognizing them as opportunities to buy at lower prices. And those who succeed aren't the ones who deny the cycle. They're the ones who prepare for it and use it to their advantage. So when investors underestimate market cycles, they set themselves up to lose. They buy when prices are inflated, sell when fear takes over, and repeat the same mistakes generation after generation. If you want to avoid being part of the 97%, you have to accept the reality of cycles. Don't assume the current market will last forever. Don't ignore history. Instead, respect the rhythm of the market, plan for it, and use it to guide your decisions. Because in the end, everything makes a good investment. The market doesn't punish those who understand cycles. It punishes those who pretend they don't exist. If there's one lesson that separates successful investors from those who lose money, investment, it's the ability to manage risk. Yet, most people completely ignore this part of investing. They focus so much on how much money they could make that they rarely ask themselves how much they could lose. And when the market eventually turns, as it always does, that lack of preparation destroys their portfolios. Neglecting risk management isn't just a small mistake. It's the difference between being in the 3% who win and the 97% who lose. The problem starts with the way people think about investing. Many see it as a straight line, put money in, wait a while, and watch it grow. But investing doesn't work like that. It's not a straight line. It's a series of ups and downs, and sometimes those downs are steep. Without a plan for how to survive them, investors panic, make rash decisions, or simply get wiped out. That's why managing risk is not optional. It's essential. Investment. One of the most common mistakes people make is putting all their money into a single investment or sector. Maybe it's because they believe in a certain company, investment. Or maybe it's because they saw rapid gains in a particular area like tech stocks, real estate, or crypto. The logic is simple. If it's working now, why not go all in? But the danger of concentration is that when that investment falls, there's no safety net. Diversification may sound boring, but it's what prevents a temporary downturn from turning into a financial disaster. By spreading your money across different asset classes, stocks, bonds, real estate, even cash, you reduce the chance that one bad event can wipe you out. Everything makes a good investment. Another way investors neglect risk management is through over-leverage. They borrow money to invest, thinking they'll multiply their returns. And while that works when the market goes up, it becomes a nightmare when the market goes down. A 10% loss doesn't just mean losing 10%. With leverage, it can mean losing everything. Too many investors get seduced by the idea of quick gains and forget that debt magnifies losses just as quickly as it magnifies gains. The result, a small downturn wipes them out completely, forcing them to sell at the worst possible time. Cash reserves are another overlooked piece of risk management. Most investors keep every dollar tied up in the market because they think sitting on cash is wasted potential. But here's the truth: cash is not wasted. It's protection. It's the buffer that allows you to survive downturns without selling at a loss. More importantly, it gives you the ability to buy when opportunities arise. During market crashes, the investors with cash on hand aren't panicking, they're shopping, they're buying assets at a discount while everyone else is selling in fear. Without cash reserves, you're stuck riding out the storm with no flexibility. Emotions also tie directly into risk management. Without a clear plan for how much you're willing to risk on a single investment, emotions take over. When people double down on bad decisions, chase losses, or sell out of fear. A disciplined investor knows their limits before they invest. They set stop losses, they determine position sizes, and they create rules for themselves that keep emotions out of the equation. That discipline what keeps small losses from turning into devastating ones. The bottom line is simple. Risk managed investment is about staying in the game long enough to let compounding work in your favor. Markets will always have ups and downs, but if you can protect yourself during the downs, investment, you'll always come out stronger on the other side. Neglecting this truth is why so many investors fail. They're so focused on chasing returns that they forget survival is the first rule of investing. If you can't grow wealth if you're constantly digging yourself out of losses. So when we say 97% of investors are about to lose money, It's not just because they lack discipline or ignore cycles. It's because they don't protect themselves against the risks they can control. They gamble instead of plan. And when the market shifts, investment, they pay the price. If you want to be in the 3% who win, don't just think about how much you could make. Think about how much you could lose and protect yourself accordingly. That's not playing it safe. That's playing it smart.